Hello and welcome back to Bunnex Investment Group. In this video, we're going to talk about a strategy that is solely for those who have a full-time job, that is a 9 to 5, and who do not have enough time to look at the markets. So, without wasting much of your time, let's jump right into the video. So what is this 9 to 5 trading strategy? It's actually a trading strategy whereby it is these qualities. One, you won't be needing to be in front of your charts a lot of times, and two, you will be actually getting high winning entries. So how do we start? Firstly, whenever we are trading, we need to have at least two time frames of observation, meaning that in this case we are observing this market. This is odd against card, and it is on the daily time frame. So the first time frame that we need to have is what we call a bias time frame, and then we need what we call an entry or confirmation time frame. So basically, at least two time frames are required for any serious trader. If you are someone who actually goes into the market maybe on the daily time frame right away, it means that you are not doing everything correctly. So our bias time frame is going to be the daily time frame, which is a high time frame that shows us where the market will flow over a long period of time. Then our confirmation or entry time frame is going to be the H1 time frame. So in short, we are going to be using the daily time frame and the H1 time frame. These are the two time frames that we'll be using, and the daily time frame being the bias time frame. By bias, it basically means to know where the market is going to move with a higher probability, and then to enter, we'll use the H1 time frame, which is not something that will require us to be in front of the charts all of the time. So basically, those two time frames are going to be required. So how do we use them, and where do we make our entries as well as our bias? So in this particular case, we actually start off on the daily time frame. So we switch to the daily time frame, and then on the daily time frame, we now go down to the H1 time frame. But before we talk about the whole strategy, we have an indicator called the BTMM Pro. You can check with the link that I've left in the description box below. This is solely for those who are finding it difficult to monitor the charts as well as getting signals. So this indicator is 65 to 75% accurate, and all the signals are sent directly to your phone, like what has been illustrated here. So make sure to get your copy using the link that I've left in the description box below. All right, back to the video. So we've said the first thing is to go on the daily time frame. On the daily time frame, we need to observe what we call points of supply and demand, especially points whereby we now have a trend. So in this case, we can see that the market was actually creating these flows. We had this as the first high that was issued. Then we had this as the first low that was issued. We are actually basing coming from this particular point. First high, first low, and then after that we had the second high like this. So if we have these highs and lows, where is our next low going to be formed? We expect or anticipate to have that low to be formed at the previous high that has been broken. So we need to see a break of this high, or a break of a low or a high, and then after that break of a low or a high, we need to see a pattern on the lower time frame. What is the lower time frame? We've said we use the H1 time frame. So on the H1 time frame, if we observe what happened on the previous case, we can see there was this W pattern when the market actually came back to the zone that we actually broke on the daily time frame. We had this particular W pattern. Someone can actually say this was not clear, but when we retested again this particular point, it was another point of market entry. So it's either at this particular point we had a point of entry. However, we need more examples so that we fully comprehend how this is done. Let's actually go to more examples. So this is Euro odd, and on Euro odd we've said the first step is to always start on the daily time frame. Going on the daily time frame, this is how it looks like. What has been issued, we can see that there is a high. Then after that high, we can see that there was a low that was created, another high, and this low creation was a break of this particular point, meaning that we had this as our point of interest. So this is where we were anticipating to get the next high, the next lower high. So this is lower high. We wanted another lower high at this particular point. So at the end of this video, I'm going to give you a trick that will actually safeguard you from being trapped with the markets. So we've said we need to see a pattern, an M pattern, a head and shoulders pattern, or any reversal pattern that we may have. So we can see there was this big M that was issued at the zone of market interest. This could have been another point of entry as an M with the second leg right below the first leg level. So this could be another entry point, but entering at a created supply zone will be the best. So entering at this particular point was going to be the perfect point of market entry. Then let's have another example. We have pound, euro, pound. First step, go on the daily time frame, and then from the daily time frame, we know the drill. We go to the H1 time frame. On the daily time frame, what is there? We can see there is creation of this low, creation of this high, low, and then on this particular point, which is a probable point of the next high, that is where we're going to make our entry. So we need to get a setup on the H1 time frame, and we can as well refine it on the lower time frames like the M15, but we've said this is for those who do not have enough time to monitor the markets. And we can see the market came back, created the first leg and then the second leg as a variated on theme M pattern. This was the rightful point of entry, and the market was still going to the downside like that. So basically we need to just start off on the daily time frame, and then after the daily time frame we go to the H1 time frame to see a pattern within the zone of market interest that has been obtained on the daily time frame. So basically like that, this is how you actually be able to trade whilst you have a full-time job, and it will be less requiring you on the charts. On that note, we've come to the end of our today's video. Thank you for watching. Like and subscribe, and I'll see you in the next one.